What do you think about Friday was a whole mess of crazy news, starting with the jobs number, but then firing the BLS chief. And how bad is the labor situation?
So we've felt, and I've been saying for some time, that hiring is down to stall speed. That's been true, I think, for the last few months. The reason the unemployment rate is so low is not that businesses are firing, they're not, but they're not hiring either. And we're losing labor supply because of the immigration policies. So I agree with what Governor Cook said. You've got to look at more than just headline unemployment to understand the labor market. The labor market is weaker than headline unemployment suggests. And the reason, again, is businesses are not hiring. Hiring is very sluggish, and it just doesn't look as bad as it might because supply is also declining. So I agree with the conclusion there's weakness in the market. So the BLS numbers from Friday, for me, it was a little weaker than we expected, but it was confirmatory. The backward revisions were not a surprise.
But does it concern you that it looks like when the president doesn't like the data he's getting, he fires the statistician? That doesn't seem like, that seems like something that would happen in China.
So I joined the Fed 10 years ago. First thing I learned in my first 30 days, I had a talk with a very senior economist who said, don't overreact to any one data report because they're distorted, they get revised, they're based on surveys. Since COVID, that's even more true because the survey response rate is lower. I think the BLS believe they need to invest more money in technology, high-frequency data, other sophisticated techniques. But I do think that it's critical, whatever happens there, we have to have confidence in those numbers. And I don't think Friday and the backward revisions were a shocker. I think, do they need to update their practices? Sure. Should they use more technology? Yes. But it's the critical thing is that we have confidence in whatever comes out of BLS.
Well, that's the thing. This is a conversation Matt and I were having for hours on Friday, that these issues with data collection and these big revisions that we've been seeing, they predate the second Trump administration. We were talking about this a year ago, even at this time. So perhaps the BLS needs to refresh things. But it seems like just response rates are coming down, that initial collection rates are just lower than they have been in the past. So that seems like a big problem when you're trying to assess the quality of this data.
And you remember, I was at the Fed during COVID, and we found that a lot of the BLS data wasn't as reliable. So you may recall we started relying on a whole range of high-frequency data, produced by Google and others, and we had to find other techniques. I do think it would be a healthy thing to review our techniques, review our practices. I do believe the people who lead BLS are apolitical. They're trying to do the best job they can. They probably need more capital investment and more money to invest in some of these more sophisticated techniques.
It's not just changing the name at the top. Perhaps you need to fund it as well. You mentioned that, during COVID, alternative data became very popular, and that's where I wanted to go. I mean, if there's skepticism over the headline figures that we're getting from the BLS each month, and you're seeing these heavy revisions, where are the best places to look to get a sense of what the labor market in America truly looks like?
So we've got a number of private sources like ADP. What I would say is I'd be skeptical about any one data print, but I think that's why you always look at the 3-month trend, the 6-month trend, the 9-month trend. You compare it to a reality check on some of these private sources. You compare it to what you're hearing from businesses. And in that regard, I still believe, I think we've got the ability to make good judgments. You just can't overreact or over-rely on any one data print.
Are you worried at all about Fed independence, Rob? Because the president obviously has a strong view on where rates should be. I don't think that's unique. We've had presidents in the history of the United States who have had views on rates. We're hearing now that he may appoint Christopher Waller as the replacement for Jerome Powell when his term runs out. And there's a whole board, right, of people. It's not just Powell.
right.
It won't just be Waller or
That's right.
whoever gets the seat. Are you worried about Fed independence?
I think there is a very strong culture and ethic at the Fed to make decisions divorced from political pressure, political considerations. That culture is very strong at the Fed. There'll be an onus on whoever the chair is to uphold that ethic. And I know Chris Waller, for example, would, but I think a number of the other candidates, it'll be very important that they do also. But yeah, there are 12 votes around the table. The chair doesn't make the decision. He or she needs to form a consensus. And I think each of the people I know around the table adhere to that ethic very strongly.
I also want to ask about rates, about treasuries, because it felt like we were floating up. Katie pointed out earlier, we were around 450, and now it looks like from Friday we've reset to 420, but we still have the same demographics in these United States. Baby boomers aren't retiring. They're taking their money out, right? China isn't buying $4 trillion worth of treasuries. And in fact, the rest of the world is maybe looking elsewhere. There is concern about things like when you fire a BLS statistician, the dollar has weakened. I mean, shouldn't the pressure on rates be upwards? Shouldn't 450 be the new normal? Why are we at 420?
Here's why we're at 420. Prospects for future growth have slowed. Remember, we started the year, the Treasury was at 450, but we thought on January 1st, I think the estimates for GDP growth were 2.25%, 2.5%. Today, they're closer to 1.25%, 1.5%. And interestingly, the 10 years rallied a little, but maybe not as much as you would have expected. So why hasn't it? The term premium, the concern is that the term premium is inching up. Why is that happening? We got 37 trillion of treasuries to sell, and heading north, we're running a $2 trillion deficit probably this year. And so the 10-year is affected by supply-demand factors and prospects for future growth. Normally, if I told you GDP expectations were declining this much, you might have expected a bigger rally in the 10-year than what we've seen. So the front end of the curve, there's been a lot of debate about that. That'll be based on Fed decisions, and we can talk about that. The back end of the curve, the further away you get away from the Fed funds rate, is more about the deficits, prospects for future growth, supply, demand of treasuries. And yeah, there's some concerns and vulnerabilities given how much treasuries we're trying to sell.
Well, let's talk a little bit more about the front end of the curve and future policy decisions. Specifically, let's talk about September, because it feels like the market has really coalesced and decided that September looks more likely than not that we're going to see a rate cut. You were telling us in the commercial break, though, that that's not exactly a sure thing.
It's not a sure thing. I think there's, in my opinion, I think if I were in my former seat, I would be tilting very seriously to thinking about cutting in September. So there are cross currents, and here's why I say tilting. We're running above 2% inflation. Whether we like it or not, the tariffs are going to raise costs. Some of it we'll negotiate with suppliers. Some of it will come out of margin. And yes, some of it will translate into prices. We also have a very tight labor force, which makes wages a little bit stickier, although we see some weakness there. At the same time, you got an AI boom, you've got global overcapacity in manufacturing, you've got regulatory relief coming, you got sluggish growth. All those things are disinflationary. So if I'm going into September, I'm saying if I see one more negative jobs report to confirm what we've seen, this trend, which you'll see in early September, yeah, I'd be inclined to believe that maybe I'm willing to take some risk in order to head off a further weakening in the economy, understanding I also got to have some confidence that while prices are edging up, when we look back a year from now, these disinflationary forces will make those price increases more likely to be one-time, not persistent. But that's the tension that they've been balancing.
That tension, is it worse than you've seen in some time, the conflict of the Fed's dual mandates?
It's been some time since we've been in a situation that we were at risk of not meeting our employment mandate and we were having above trend inflation. And so normally, okay, job market's strong, we can be tough on inflation. Now we've got an issue with both. And so this weakening, if it persists, it means I'm going to have to take more risk. And my guess is that will mean taking a serious look at cutting 25 basis points in September, but I would caution that doesn't mean we're starting a rate cutting cycle. After September, if we cut, you wipe the slate clean and take a fresh look at November, fresh look at December. Remember, we've got tax incentives coming. We're still running a historically high deficit. We have accelerated depreciation coming. And so I think you'll shorten up your time frame, take it one meeting at a time. But for September, I'd be seriously thinking about cutting.